A very warm welcome. And now we have Mr. Naveen Chandramohan, the founder and principal fund manager at ITUS Capital. Now he is responsible for running the fund and takes all the portfolio and risk decisions at ITUS. Mr. Chandramohan has had illustrious career spanning 15 years in the financial services sector, having worked across fund management, fundraising, and fundamental research. He began his financial services career with Lehman Brothers in Tokyo as a senior analyst in the capital markets trading desk, and he has a proven track record of managing money and being ranked the best fund manager between 2012 to 2014 by Asia Hedge in Hong Kong. At ITUS, he runs a growth strategy investing in cash flow based growth, which provides portfolio downside protection across cycles.
I sort of have an approach of momentum investing, and I like to be tactical in my investment journey. Whereas a large percentage of the investors out there, they hold on to their winners, and that is the real joy of investing, right? So how common approach me was that we should like I should get inside as a momentum investor what makes a investor a good portfolio manager to hold on to the winners that they have. So that is what I try to do in this session. Uh, get the insight on when do you want to be tactical in your investment, and what leads you to really stick to the winners that you're holding. Selecting high conviction stocks, typical holding period that you sort of work with. Naveen, you can talk about your approach and what you look at, and how do you hold on to your winners.
Sure, Sonam. Thanks for this. So, Sonam, just to be framework of what is high conviction to us, right? To set the context, we only run one strategy. So, why do we run only one strategy? I think the philosophy has been very simple because our entire net worth is in the fund as promoters. Right? That was how we actually set up our AMC. It was a vehicle to manage our money first and investors' money second. Right? So, for me, it was really important that this framework that we choose is an extension of what we and my analyst team believe in. Okay? And for the hallmark of a successful business, and different people have different hallmarks. For us, at least, it's a two-levered approach. One is cash flow growth. And analysts in general look at earnings growth, revenue growth, EBITDA growth. You can in my mind, is a lot of this is manipulatable, right? The hardest thing to actually manipulate from a balance sheet perspective is cash flows. And if you look at history, not just in India, but US, there are two companies in the history of humanity which have manipulated cash flows. One is Enron and second is Satyam, right? So it requires a concerted effort from people in the system to manipulate cash flows. Very hard to do. More importantly, why is cash flows even important, right? Because for me as a promoter, when I'm planning for my business, let's say 1, 2 years, 3 years down the line, what's important is how do I reinvest this back into the business? Because that is what is going to drive future growth. I'm not buying past growth. I'm actually looking at buying future growth, right? Now, if I'm going to fund my future growth as an entrepreneur, predominantly through debt or diluting my equity, me as a minority shareholder, I have a higher chance of getting hurt over time. And I want to minimize that risk. So how do I measure that as an analyst? I look at return on incremental capital invested into the business. So if I combine the two levers, one, the businesses that have an ability to generate cash flow growth, and two, the return of incremental invested capital, potentially I have the ability to generate and hold on to my businesses from a higher conviction perspective. Now, coming to the second part of your question, holding period. I think holding period, we all want to be long-term investors, right? That's the aim when we run the fund. But things change along the way. Just because business cycles change and markets change, right? So, and the implicit nature of this change is one of these two things will eventually change, right? Cash flow growth will drop, which means you as an analyst need to take a call on whether it is structural or it's more of a temporary headwind that you're facing as a business, or return on incremental capital will actually drop. And if that drops, you as an investor need to actually take a decision whether you want to allocate capital to this company or you have an opportunity cost of holding on to this business. So typically we get into businesses with a shorter time frame of 3 years. And as the performance executes, as the business owner continues to execute, we would like to typically hold on to longer, but it is a metric of execution along the way. So that's how we think about holding period. So if I look at the fund, we've run it for 5 years. Our average holding period, though average is a misleading word, has been 3.5 years. The longest that we've held on to a business has been since inception. We've not sold out. And the shortest that we've done is 1.5 years. So it gives you a range of how we've looked at it internally at a fund.